Good afternoon and welcome to Markets Today. Today we will be giving you highlights on what's happening in the markets, but we've also taken a twist in terms of the insights that we'll be sharing. The IMF has released and published a report evaluating whether the interest rate caps are working, what has been happening before, what's happening currently, and more importantly, proposing what needs to happen thereafter. This is a topical debate for us at this point in time, largely because the budget was read last week. We have an extensive deficit. From the papers that we have seen, 600 billion shillings to be exact. We need to be able to raise 3 trillion shillings to finance the government operations. How are we going to be able to do this? And is there any opportunity to actually lift the interest rate caps, something that was proposed by the CS Treasury, to repeal it in totality? If we cannot repeal it in totality, what can we do? But first, let's have a look at what the IMF is saying. The IMF has actually done an empirical research looking at data from the Central Bank of Kenya and the Kenya Bankers Association. Based on these data sets, which are running over 3 years, just before the rate cap, which was instigated in 2016, August of 2016, they've been able to evaluate that data and look at who has been the beneficiary and who has lost out, and in terms of losing out, what sectors have lost out. In their report, they've also compared which other countries globally have assimilated what Kenya has done and what have the results been. Interestingly, none of the other countries that they looked at and compared to Kenya have done what Kenya has done. They're actually saying that Kenya's move to actually have a rate cap ceiling and also to have a floor in terms of the cost of deposits has been extremely punitive. What most of the countries tend to do, they will have a ceiling in terms of how much you can extend on loans. So for instance, what we have done is we've capped the ceiling at about 14%. Most countries would typically have that and have a reference point. What they will not do is have a floor that says you can only be able to pay this percent for deposits. For Kenya, the case was 7%. Initially, before that, the bulk of the deposits were actually being priced at 2%. Remember, if you're a retail investor or a retail person who puts your deposits in banks, you are lucky if you even got 2%. You probably needed to have a lot more money to be able to get the fixed terms. Now, let's take a delve into the interesting charts that are coming out of this conversation. Here we are looking at the savings deposits and how they looked like before the rate cap happened in August. If you notice here, about 53% of the deposits before August were priced at below 7.35%. 7.35% is the number to look out for, because once the law changed, then the interest rate capping meant that all the banks had to pay 7.35%. In other words, prior to this rate cap, the cost of funding was well below 7.35%. It was actually anywhere between 2 to 3% for the smaller banks and anything between 0 to 2% for the tier 1 banks. Once this happened, there was a complete overhaul of the pricing. Can you imagine moving from buying something at 2% and then overnight you have to buy it at 7.35%? That has an impact. We will be discussing that later on. Of also importance for you is to recall that before the cap on interest rates again happened, on the lending side, 60% of the total deposits in the Kenyan economy were priced at over 14.5%. You remember, maybe most of you had facilities and used to pay anything between 20 to 24%. The beauty of that is you are able to access credit much faster than you're able to assess it. But what the IMF has done is said, this is how the environment looked like. People were able to get access to credit. But when you look at it fundamentally, the government said, no, we do not need this kind of structure. And if you remember, the objective of the rate cap was twofold. Firstly, it was to remove the ceilings. Firstly, it was to reduce the cost of credit. The government felt that paying 24% was destructive to the economy and the sustainability of the GDP growth that we were having then. The second thing is they wanted to create an option where you have alternative reference points anytime that you're pricing credit. In not so many words, the government felt that we needed to have a proper structure that was based on sound principles and sound frameworks that had been discussed by stakeholders to just get into a space where you're able to grow your credit at an affordable rate. Did they achieve this? Yes or no? We'll get right back to that. Now, some of the impacts of what the rate controls have meant for the economy. Firstly, the government has been the biggest beneficiary. Before this rate cap in 2016, the bulk of the credit used to go to the private sector. And you can actually see a sort of a spike on the total public sector credit, and that's the black line. By public sector, this is the amount of money that the government has been borrowing from one period unto the next. The domestic credit is the blue line. So it had started slowing down prior to 2016, which is here when the rate cap happened. It had already started slowing down, and what the report says is prior to the rate cap, it had become so expensive to actually borrow at 24% that it was sustainable, and the banks were unable to write out any new loans. Come September 2016, okay, we have just moved. Before I explain this, after September 2016, credit to the government has been growing at about 25%. The last numbers that came out in terms of credit to the private sector are 2%. So you have the government that's benefiting here in terms of accessing credit coming from single-digit numbers, and it's at 25%. But you have you and I and anybody else in the private sector, whether running a large corporate or an SME, right back down here in terms of 2%. Oh yes, here we have the chart again. This is what you need to be focusing on. This is where the rate cap happened. Look at the jump, very aggressive jump. What does this jump mean for you and me today? This is the jump that has actually been financing the fiscal deficit. So today, when the government says they need 600 billion, they're very confident that they can collect half of that from the domestic market. If they collect 300 billion from the market, then that means you and I don't have access to credit and we cannot grow anything that we want to do. We'll take a short break. Keep it right here. We'll keep discussing this.